We don't yet know who the AI winners and losers might be. Joining us now is Nuveen's Chief Investment Officer, Saira Malik. Saira, good to see you. So even though the internet turned out to actually be this world-changing thing that investors in the late 90s and 2000 hoped, we went through this trough of disillusionment when Amazon was trading at this huge discount. How do we tell if the same's coming for AI?
Well, tech tends to lead the market up, so it's going to lead the market down. And I think what investors are wondering is what's next after the Fed finally cut interest rates for the first time this year a couple of weeks ago. And the market is concerned about three factors. That's the rate of inflation, economic growth, and the pace of Fed rate cuts going forward. With inflation likely to remain sticky, we'll see that with PCE data tomorrow. Economic growth is slowing. We're seeing that with the employment markets. And so if you look at technology stocks, they have a premium valuation, but AI in general is alive and well. We're seeing very strong growth there. And companies like Avago and Alphabet are leaders in this space, and they will continue to be because of their strong earnings growth and the investment being made in artificial intelligence.
So give the viewers some practical strategy advice. How should you position yourself if you do believe that AI is great for the long term, but you also want to protect for near-term downside and volatility?
Well, you can balance your portfolio. So just looking at, first of all, Avago and Alphabet, both of these companies are positioned very well. With Avago, they have huge demand from hyperscalers for their A6 chips, very strong management team, ability to earn a very strong earnings growth going forward. The stock actually is not as expensive as one might think, given its earnings growth trajectory. Looking at Alphabet, people are worried about what will the impact of OpenAI be on Google's advertising business and Genesis. I think the impact is not going to be as great as people think, and you have the upside from Waymo and their YouTube business. So if you're looking at AI, you want to own the companies that will be winners over the long term, which were the two I just talked about, and then you can balance that. We are seeing the market broaden out a bit. So there's areas like infrastructure, which has its own tailwinds. It is a data center play as we build more of those in the US, but as we need to electrify our grids, part of infrastructure is utilities, so we're going to need more and more upgrades to our utilities. And then, of course, waste management is a big component of infrastructure. So it's a sector that tends to be a little bit more defensive and an inflation hedge. So you can offset some of your tech picks with areas that are more defensive, like infrastructure.
Sarah, we had so many Fed speakers making so many comments this week. And stagflation, or the concerns around stagflation, especially as we look to the PCE report tomorrow, seem to be what's in the ethers here. So does the market continue to broaden if that actually becomes realized?
Well, why the market's been mixed recently is because now that we've gotten that first rate cut under our belt, what are we going to see in terms of the pace of rate cuts going forward? Our estimates is for 3 more rate cuts in the next 12 months. Now, I don't know if that's going to be 1 or 2 in 2025 or if it's going to be in the next calendar year. So that's going to be one issue. Now, on the stagflation debate, the issue around that is the employment markets. We have seen payroll significantly slow over the past few months, with revisions also declining significantly. It's going to be crucial to continue to watch the payrolls and employment markets because recessions tend to start as employment markets crack. I don't think we're at that point yet. You saw GDP today. The economy actually is still doing quite well. So a recession isn't imminent. But if you hit that point where the economy slows enough because of the employment markets and inflation is still sticky around 3%, that is going to be a period of stagflation. But I don't see us in that category at this time.